Hey everyone, welcome back to Corporate Decoder. Today, JPMorgan Credit Markets Fund just filed a new registration statement, and I am seeing some really interesting details about how they plan to operate. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a peek under the hood of a new investment fund, revealing their strategy, fees, and the risks investors are taking on. Alright, let's dive into the JPMorgan Credit Markets Fund. This is a newly formed company, essentially a trust that is registered to operate as a closed-end management investment company. They've got no history yet, meaning they are just starting out. They also plan to operate as an interval fund, which is a bit different from your typical mutual fund. Their main goal is pretty straightforward: to make money over time through income, and by growing the value of their investments. To achieve this, they're going to focus on credit investments. Think of things like loans, bonds, and other debt. Related products, they want to actively manage this portfolio, meaning they won't just buy and hold, but will be making changes based on market conditions. Now, how they get exposure to these credit investments is pretty interesting. They'll invest in other funds, which they call portfolio funds. They might buy into these funds from existing investors, which they call secondary investments. They can also invest directly or indirectly through other vehicles, which they call co-investments, or make primary investments directly into portfolio funds. They'll also deal with structured finance securities. It sounds like they're building a diversified approach within the credit space. A key policy here is that they plan to put at least 80% of their money, plus any borrowed money, into these credit investments. This is a significant commitment to their core strategy. To make sure they have cash when needed, they'll also hold what they call liquid assets. This includes things like government bonds, money market funds, and even cash itself. This is crucial because they operate as an interval fund, which has specific rules about repurchasing shares from investors. When you invest, you'll see there are 3 different classes of shares: Class A, Class A, and Class I. These classes can have different fees and expenses, so it is important to understand which one you are buying. Let's talk about fees, because that is a big part of any investment. For Class A shares, there is an upfront sales charge. If you buy $100,000 or less, you'll pay 2.25% right off the top. For larger purchases, the upfront fee goes down, and if you buy $250,000 or more, there is no upfront charge. But if you sell those big purchases within 18 months, there is a 1% contingent deferred sales charge. Class S and Class I shares, however, do not have that upfront sales load. But Class S shares might have fees charged by your broker or financial advisor up to a 3.5% cap. Class I shares generally avoid these intermediary charges. Then there are the ongoing fees. The investment advisor, JPMorgan Investment Management Inc., gets an annual advisory fee of 1% of the fund's assets. However, they have a special deal for the first year. The advisor is waiving most of their fee, bringing it down to just 0.25% for that initial year. After that, it goes back up to 1%. This is a common practice to attract initial investors. A big chunk of the ongoing expenses comes from what they call acquired fund fees and expenses. This is because they're investing in other funds, and those funds have their own management fees and potentially performance fees. The document mentions these acquired funds can charge management fees between 1 to 1.5% plus performance fees. So you are paying fees on fees. There is also an expense limitation agreement. The advisor has promised to limit certain operating expenses, excluding a lot of specific costs like borrowing costs or legal fees, to 1.10% of the fund's assets. This is a nice buffer for investors, but it is important to note what is excluded. When you look at the total annual expenses, they can add up for Class S shares. After the fee waiver, it is about 3.27%. For Class A, it is 3.02%, and for Class I, it is 2.52%. These are significant ongoing costs, especially considering the fund is investing in other funds that also charge fees. Now, let's talk about the risks. The fund is classified as non-diversified, which means it can invest a larger portion of its assets in a smaller number of issuers. This can make it more vulnerable to a single event impacting one of its holdings. It is also a closed-end fund, and importantly, an interval fund. This means you can't just redeem your shares whenever you want like a typical mutual fund. Your shares won't be traded on a stock exchange, and they don't expect a secondary market to pop up. Liquidity is only provided through periodic repurchase offers. As an interval fund, they're required to offer to buy back shares from investors periodically, typically quarterly, but they can only repurchase between 5 and 25% of their outstanding shares at a time, and they currently plan to do only 5%. This means you might not be able to sell all your shares when you want to. They are very clear about the risks. This is a speculative investment with a substantial risk of losing money. They emphasize that the fund has no operating history, which is always a red flag for new ventures. A major risk they highlight is that they'll be investing in other funds, which means you are indirectly exposed to the risks of those underlying funds. If those funds perform poorly, your investment in this fund will suffer too. Plus, you are paying layers of fees. They're also using subsidiaries to make investments, which adds another layer of complexity. While this can sometimes be for tax or regulatory reasons, it is another thing to keep track of. Remember that non-diversified status. They explicitly state this means they can invest a larger chunk of their assets in just a few companies, increasing the risk if one of those companies hits a rough patch. They also admit their due diligence process might not catch everything. When investing in private markets, information can be scarce, and there is always a risk of fraud or misrepresentation from the companies they invest in. On the tax front, they intend to qualify as a regulated investment company or RIC. This is generally good because it means they avoid paying corporate level taxes if they distribute most of their income to shareholders. However, meeting the rules for RIC status, especially with investments in other funds, can be complicated. Just a minor detail, but their fiscal year ends the 31st of March and their taxable year ends the 30th of September. And their independent auditor is PricewaterhouseCoopers. The financial statements show that as of the 15th of July 2026, the fund had total assets of about $652,000 and total liabilities of around $551,000. This leaves net assets of roughly $101,000. This is their starting capital, with most of it invested in a JPMorgan government money market fund. The majority of their assets, almost 100%, are in an affiliate fund, the JPMorgan government money market fund. This makes sense for a new fund getting started, but it is worth noting they are investing in another JPMorgan product. Their net investment income for the period from November 2025 to July 2026 was about $1,244. This income mainly came from interest and dividends from their affiliate investment. Notably, the organizational costs, which were about $181,000, were fully reimbursed by the advisor, meaning the fund didn't bear that cost initially. So, looking at the whole picture, this is a fund aiming for long-term growth by investing in credit markets, using a complex strategy involving other funds, and offering different share classes with varying fees. The risks are substantial, especially with the no operating history aspect, the non-diversified nature. And the limitations of an interval fund structure, the fees, while somewhat mitigated in the first year, are still significant, especially when you factor in the underlying expenses of the funds they invest in. It's definitely not a simple, low-cost investment, and investors need to be comfortable with illiquidity and the inherent risks of credit markets. That is my take. Stay decoded. If you found this analysis valuable, please like and subscribe. Check out the Discord link in the description.